Let's examine the claim that GDP drives stock prices. In his landmark book, The Socionomic Theory of Finance, Robert Prechter reveals 13 market myths which harm investors. Most investors accept these ideas as true, but they trick investors into making unwise decisions. You can read them all for free by following the link below. But I want to show you one of these myths, which has to do with the nation's gross domestic product. Many market observers believe that GDP has a considerable amount to do with driving the stock market, so we often have headlines like this: S&P 500 index climbs higher on better than expected GDP growth, or Dow Industrials plummet on disappointing GDP data. Granted, it does seem that a nation's gross domestic product would have a causal effect on the main indexes. After all, the level of total corporate success is reflected in GDP, and as you know, stocks are shares in corporations. Even so, here's what Robert Prechter notes in the Socionomic Theory of Finance. Suppose you knew for certain that GDP would be positive every single quarter for the next 3 3/4 years, and that one of those quarters would surprise economists in sporting the strongest quarterly rise in GDP over a half-century span. Would you buy stocks? If you had acted on such knowledge in March 1976, you would have owned stocks for 4 years in which the Dow Jones Industrial Average fell 22%. Robert Prechter continues with another example as he shows this chart and says, suppose you possess guaranteed knowledge that the next quarter's GDP would be the strongest over a span of 15 years. Would you buy stocks? Had you anticipated precisely this event for the fourth quarter of 1987, you would have owned stocks for the biggest stock market crash since 1929. GDP, moreover, was in the middle of an extended period of expansion, turning in a positive performance every quarter for 30 straight quarters, 20 before the crash and 10 thereafter. But the market crashed anyway. 3 years after the start of the fourth quarter of 1987, stock prices were still below the level of that time, despite 10 more uninterrupted quarters of rising GDP. Granted, GDP and stock prices are allied much of the time, but if exogenous causality was at work, they would always be allied. Yet, as we've shown, they aren't. In fact, they are often diametrically opposed. This is only one of the 13 market myths that you will find as you access chapters 1 and 2 of the Socionomic Theory of Finance for free by following the link below.